Let's start off with China. This new rate system, markets disappointed. Does it necessarily mean lower rates going forward? And can it generate demand for new credit, you think?
Well, I think it's a race to the bottom. As you know, globally, with the Fed leading, all the central banks around the world are moving towards lower and lower rates. And I don't think China can escape that phenomenon. And as you know, they've already given up on the currency. They've decided to break that magic 7 level. And now we're in a situation where the sky's the limit, really. So I think we're going to see lower rates in China and elsewhere.
It's the right move, though, yeah, Mark, because it is liberalizing its financial system further. This is a step in the right direction.
Yes, it is a step in the right direction, but believe me, it's going to take a long time before China gives up control of its interest rates and its exchange rate. So I don't think we can expect a truly liberalized market for a long time to come.
Mark, looking at Chinese stocks, they've done better than the S&P all year long. Given that they're getting higher weightage in the MSCI, well, the only way is up? Or do you think the risk of a slowdown in the economy would play a bigger role in how investors look at China?
Well, I think there are two aspects here. One, of course, is the index weighting. China's index weighting is going up step by step. The MSCI and other index providers are increasing the weighting of Chinese stocks, which means billions of dollars of ETF and index funds have to go into China. There's no two ways about it. The other side is, don't forget, China is still growing at 5, 6, 7%, whatever number you want to put on it. This is tremendous growth. So there are going to be many opportunities in China to buy good stocks that are yielding high dividends and are growing at a good pace.
Mark, what are you buying then? And what are the opportunities in China, especially at these times when we've got all these geopolitical uncertainties?
Well, the key in my mind is dividend yields, because with the situation in interest rates around the world, people are now looking at yields in stocks because they're not getting anything in the bank. And in fact, as you know, in Europe, they have to pay the bank to keep their money. So I think there's going to be more and more interest in Chinese companies as well as companies around the world who pay good dividends. That is the key, I believe.
All right, so there's that. What about the bond market? How close, I mean, with this new reform coming in place today, how closely are you looking at that as a burgeoning one with more and more liquidity coming in as well?
Well, what we're looking at is what companies are able to raise money and how risky is the company as regards to being able to pay back those bonds. This is a very, very difficult situation. And talk about risk on, that's really risk on, because we're racing to the bottom, as I mentioned, and we're in a situation where more and more companies that are really not qualified to raise issues are going to be raising those issues and putting investors in potential harm. So this is something we have to watch very carefully. I'm not just talking about companies, I'm also talking about countries. So we're in a situation where the risk is going to be increasing at a pretty rapid rate as people rush to try to get yield.